This is Colin Cattell with Palisade Radio. Returning on the show today is Mike Swanson, publisher of WallStreetWindow.com. Mike, welcome back to the show.
Oh, thanks for having me. How are you doing?
I'm doing good, and I hear that you just got back from a few days in North Eleuthera in the Bahamas, hanging out with our good friend David Skarica. That must have been a nice little trip.
Oh, yeah. It was really interesting because I went down there last year at the very end of September. And at the time, the stock market, the internals inside the stock market were horrible, and gold was declining, oil was declining in the month of September, just about every market in the world. However, the stock market averages in the United States were still doing relatively well. And we did this video pointing all this out to everyone and warning that this meant that the market itself, the S&P and Dow, are going to decline. And they did in October. They fell sharply. So it's kind of interesting to go back and see him again and see where we stand since that all happened.
Yeah, well, I think that both you and David have a similar view right now that the stock market is in some type of a topping pattern. Before we got on the call here, you just explained to me the idea of the internals declining. It's a very simple concept. So, for example, Apple, the largest market cap stock, is still going up, but most of the stocks are topping off or dropping right now. So people have this perception the market's still strong. But you're seeing by looking a little deeper that maybe that's not the case. Can you elaborate?
Yeah, well, what tends to happen at the end of a bull market, which is what I call a topping market, is a couple things. And one of them is that the number of stocks participating in the market rallies diminishes and it actually continually diminishes and gets worse. So when the market makes new highs, there's stocks that stay well below those highs or actually continue to decline. And one simple thing people use to measure this is the advanced decline line, which divides the number of advancing stocks by declining stocks every single day. And for the NASDAQ, that actually topped out in the first quarter of last year. And while the NASDAQ has been going higher, which is a huge negative warning sign. And another symptom of this too is that these stocks that are going up, there's much fewer of them, and they're kind of like junk crap stocks. So if you watch CNBC regularly, they tend to focus on whatever is hot that week, or the day or whatever. When you see Jim Cramer or the Fast Money people, and if you watch this, what's kind of interesting is that right now they're just talking mostly about these stocks that very few people even own or heard of, the biotech stocks or things like Lululemon or some kind of really obscure stuff. Whereas a year or two ago, they may have talked about Tesla last year, or more blue chip stuff like Walmart or General Electric, or you just mentioned Apple or so forth. So the stocks that are people are getting excited about are like really obscure crap, and that's also something that tends to happen when you get to the end of a bull market, because the stocks that everyone knows and likes are so overpriced that the traders aren't really attracted to them anymore. So they're buying stuff that you really can't measure by earnings, and you're just praying that they'll come out like a biotech, maybe it'll discover the cure for cancer or something. And in fact, I've seen some biotech, I don't want to mention the name of this company, but there's one that's really hot right now that, like 4 or 5 years ago was claiming it had a vaccine for AIDS that it was going to develop, and it was a total fraud. Now they're claiming they got a cure for Alzheimer's disease. Which who knows if they're doing another game or not, but that stock's been red hot. That's kind of the stuff going on in the stock market. But the other thing too that tends to happen is the market gets more volatile, and then at the same time it's not really going up as much as it appears to people that's really happening. So for example, we've seen the NASDAQ get above 5,000 twice this year, but each time it's done that, the people on TV get really excited, and it gives you this impression that all this money is being made, when in reality, all the money has already been made. The market bottomed 6 years ago, so all the gains been made over a the past couple years, and they're not really being made now, even though the people aren't talking like that. So as we're talking, in fact, the S&P 500 is down year to date. So I actually think this is a market where people aren't really making much money anymore in it, and most people are probably actually losing money, even though everyone on TV is so bullish and excited about it. And that, I think, is an indication of a topping market going on.
Well, this is an interesting concept because we always look at a bear market talking about how a bottom forms and the contrarians get in without the general public even noticing. And by the time people catch on, you can look back and say, okay, the bull market actually started quietly a year or 2 years ago, even though the charts might have indicated that we're still in a bottoming process. So typically, I think on a topping process, like a stock market, we look at it as an overnight event. We hit the top and the crash occurred. There's a lot of signs that we can look at and pick out, hey, a lot of these stocks are actually falling off, and there's just a couple big stocks leading right now. And maybe that's something that's been starting this year. I mean, how much longer do you think this is going to take till people realize that a top is in?
Well, I define a bear market as one in which the averages are below the 200 and 150-day moving average. The indices are below those levels, and those act as resistance. So for the S&P 500, they would take a drop below 2,000 at this point for that to occur, which isn't far away at all. So in October, we briefly went below that level, but then came back immediately. This time, for a bear market to happen, we'd have to fall, let's say, to 1,900 and then have a weak rally, and then you're just in a bear market at that point because those moving averages would act as resistance. However, so I think that's what we're facing, and that process could play out over the next couple months. However, that doesn't answer your question, which is when will people notice? And in 2007, that actually started to happen in the fall of that year, but people didn't really realize we were in a bear market until 2008 after everything crashed. In fact, at the time, I was pointing this out in my newsletter that this was going on, and most people were just ignoring me. Even my paying subscribers, they were like, "Oh, whatever," because what will happen is, as the market declines, you'll see these rallies that play out for 2 or 3 days, that tend to keep people in and hopeful and so forth. So it really is until they really lose lots of money that people wake up and then realize, oh, we're now in a bear market. But by then, they can have lost 30-40% of their gains that they had before, or be down that much.
Yeah, exactly. And if the stock market is frothy and at a top right now, we can touch on a market that we've talked about in the past that is at a bottom, and that's gold. And before we go into gold and what you think about it, can you think of any other asset class or any other markets around the world? I guess there's some currencies against the US dollar that are cheap right now, but they're all paper currencies. I don't know if they have anything to them. Is there anywhere else you see contrarian opportunity like you do in gold and gold stocks right now?
Yeah. I'm not sure of the exact timing though, but I would say the Russian stock market, for example, it's got a cyclically adjusted P, which is the 10-year price to earnings ratio average for 10 years adjusted for inflation. It's under 5, or in the United States, it's above 27. And 4 was the bottom of the Great Depression for the United States. So that's a super, super cheap market. And it's linked to commodities, and I think eventually commodities are going to go into a bull market. So, I think that's an opportunity. I don't know exactly when it's really going to go up in a sustainable manner. And the Greek stock market, is negative as everyone is on that, at some point, I think that can go up to a bull market, but it may end up going lower before it does. So I do think there are some places that are worth watching. And commodities in general, typically what happens with them is gold and silver, the precious metals complex, tends to start a bull market first, and then the other commodities begin bull markets 6 months to 12 months later, and oil actually ends up going up last. So I'm looking for, at some point, bull markets to start in all commodities, but gold and silver should go up first. And one of the things about this market which I think is different than the last two bear markets for the United States, is that in both those bear markets, bonds went up as interest rates fell. The Fed reacted to the drop in the stock market by lowering rates, which makes bond prices go up because they trade opposite to interest rates. Well, this time interest rates are already at zero, and we have debt problems all over the world. So bonds are already so high that I don't see any upside to them that's worth people to take a risk in buying them. In fact, we could face a situation where bonds go down with stocks at some point next couple of years. And in that situation, people are going to be forced to look for an alternative. And I think that's going to be gold and precious metals. So, so I'm very bullish on them and think they're the place to buy. I don't know, exactly when they're going to go into bull market. Again, I define a bull market as when the prices are above the 150 and 200-day moving averages and they're acting as support. And so for that to happen, gold needs to go through essentially the 1240 level and stay above it for several weeks. And since 2011, they haven't been able to stay above that level for more than about 2 months. But I think they're going to do that before this year is over. So I think that's what people, if they want to buy something, that's what they need to really keep their eye on. In fact, I think that a good allocation for most stock market investors is to have 10% of their money in gold to protect themselves from the next bear market.
Yeah, that's right. And I think that a sentiment you might share with, say, David Segreika or another friend of ours, Jordan Roy Byrne, is that the stock market is going to have to show weakness. We're saying it's already showing weakness, but it's going to have to break down a little bit more before there's capital necessary to flow into gold and the gold stocks. I guess, what do you think we're going to have to see in the general equities that's going to relate to the gold? Or is it totally disconnected, doesn't matter?
I think we're going to see the market drop, anyway. And I think if it just falls like it did in October, which wasn't, that in the big scheme of things wasn't that big of a drop. But if we just get a 10% drop off the highs, I think that's enough to make the Federal Reserve say we're not going to raise rates, and then that'll make gold go up. And I actually think the market will end up falling more than 10%. So I just think that's going to do it. But one of the things about gold, which I think people, everyone is conditioned by what they've seen in the past, and to expect that to happen again. So I mentioned how bonds may play out differently this time than they did in the past. And most Americans are taught to say, well, if I put 60% of my money in the stock market and 40% in bonds, I'm well diversified and so forth. And I'm suggesting that's risky because if bonds go down too, they're going to just blow themselves up with that idea, thinking that they're safe when they're not. However, with gold, we've seen two bear markets in the United States stock market in the past 15 years, in 2000 and in 2007 and 8, in which gold actually fell first with the stock market and then went up months later or years later. So in 2000, in that year, gold stocks got totally crushed in the fall and then actually bottomed out and then went into a new bull market in 2002. And in 2008, of course, they crashed in the fall with the stock market. So I think there's a lot of people kind of expecting that to happen again, saying, well, I'm going to wait for this crash to happen and then I'm going to buy. I don't really think that's going to happen. And the reason why is that when the U.S. stock market tops out, there always seems to be something that goes into a bull market at the same time. Well, for example, in 2000, in March and April of that year, the NASDAQ topped out and had a violent correction in April 2000. Well, at the same time as the stock market had that correction, the tobacco stocks, utility stocks in the year 2000, they went into new bull markets just as the U.S. stock market topped out. What happened was they had already declined for several years and had reached super cheap valuations. They're paying big dividends, and they entered new bull markets. And I think the gold stocks can be the equivalent to them. They were acting as safe havens in 2000, and the gold stocks, they've already been in big bear markets. They topped out in 2011. So I think they can go into a new bull market potentially as the U.S. stock market rolls over, instead of declining with it for several months or having a violent drop. And in fact, if you look at the gold futures market, according to the Commitment of Traders report, the small individual investor, so they're very bearish, and that, to me, that's not, that's an indication of a bottom and not a top or a prelude to a violent drop. And the commercial traders, according to the Commitment of Traders report, they're only net short like 52,000 contracts, and historically, that's a range where they are buying at a bottom too, or they have a very small short position. So I really think that the action in gold and in mining stocks is real constructive and is an indication of a bottom being formed. It's just, when is gold going to go through 1240? And I'm not trying to predict the week or month that's going to do it, but I just think it's going to happen before the year's over, and probably sooner than any of us expect. Probably in the summer would be my guess.
I would have to think that if a bull market in gold and gold stocks started before the general public caught on to the fact that the equities are falling off, and then people start selling and trying to catch the next bull market, which is gold, it's going to give it a real catapulting force upwards. It could be a pretty epic start to a new bull market. I want to finish off by asking you how you plan on playing this gold bull market. I don't know if you saw the video that Tommy Humphreys just published this week. It's gotten a lot of traction. It's about a guy who turned $20,000 into $15 million speculating in junior gold stocks. So there's that spectrum that you can play a really speculative side of this market and make more than you can make in any other market. But there's also value investing right now, because these big miners, they've been crushed. And as the gold price goes up and the realization that the oil prices have come down, the earnings that come out of these guys could be surprising. And as gold moves up, it's going to be a very good value investment.
Well, personally, what I plan on doing is using the ETFs, the gold stock ETFs, as a core position, and basically keeping about 20% of my money in that over the next couple of years. And then outside of that, doing more speculative type trading in the junior mining stocks, as you just mentioned. And the thing is, like, when it comes to the mining stocks, I just assume own an ETF instead of invest in the big caps like Newmont or Barrick or individually, because the ETF does that for me. But when it comes to speculating, I rather buy the juniors because they have the potential to go up more in price, and I'd rather just have a couple of them and have small positions in them, and outside the core positions in my portfolio.
Yeah, well, that's a good way to play it. It's an easy way for investors. You don't have to put too much time into educating yourself on individual stocks and trying to beat the market. On that note, Mike, I really appreciate you coming back on the show, and hope you had a good time down in the Bahamas. I plan to make my way down there next month.
Oh, awesome. Well, thanks for talking with me, and anytime you want to do another interview, just let me know.
Thanks a lot. So wallstreetwindow.com, all of our listeners can go there and sign up for Mike's free daily newsletter, and there's, of course, a premium subscription version that you can upgrade to whenever you feel ready. Thanks a lot, Mike.
Yeah, thank you.